Welcome everybody. This is the Thursday evening Viper Trading webinar. If you're here to learn about trading the futures markets using the Viper tools, you are absolutely in the right place. We're going to knock out our standard disclaimer first. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Nothing contained in this webinar, other webinars, including the live trading room, are to be construed as investment or trading advice. Everyone in here does know that you do trade at your own sole discretion. All right, tonight's topic is when to let runners run and when to scalp. So, since we have a lot of people, since we have a lot of people visiting on a free trial for these 2 weeks, this week and next week, we got a lot of new faces and a lot of people visiting, and some of this might be the trading aspect of what you're looking at here might be completely new to you. So I'm going to sort of do a refresher on the basics. And I'm going to start with a Russell chart. So without further ado, now this used to be screen 1, but it might have changed to something else. It might be screen 4. Stand by. Shifting to a Russell chart right here. How are we looking? RTY, everybody see an RTY 4-range chart in front of them? Anybody not see a Russell chart? Roosty bird, Russell. We call it the Roosty bird. Just a funny name for the Russell. Futures markets. We trade the futures markets here. Everybody see it? Okay, good. Now, this is yesterday's data. I'm going to start with yesterday. And to get everybody oriented, I am located here in California, so this is all Pacific time. So midnight yesterday would have been here. Now, markets, in order to determine what types of trades we want to take, long, short, or perhaps long and short in a range, we need to know the condition of the market. Excuse me. So let's look at this area right here. What was the condition of the market in this area right here to the left? Up, down, or sideways? Now, so for the next 5 minutes or so, when we go through this little series of sort of pop quizzes, if you will, you can just type in a U for up, D for down, or S for sideways. So let's start with right here. Everybody see my cursor? I'm circling this area. Up, down, or sideways. Now, I'm only going to give you 5 seconds for these, so you got to quickly type in your response, because we're going to go through a lot of these, a lot of them, on lots of different instruments. Yeah, it's up. Trend is up. Characteristics of an uptrend are when you have higher highs and higher lows. Generally speaking, the background will be this sort of light green color right here. The mid band, which is the big chunky band in the middle here, we call that the mid band, and all the bands around it are stair-stepping up. Bars are predominantly blue, and we are said to be in an uptrend. So when this is said to be an uptrend. Now, when you're in an uptrend and it's a strong, powerful uptrend that's running for some period of time, we want to buy on pullbacks. So we're going to buy on pullbacks. So what is a pullback? Let's talk about that for a second. Now, I'm just talking conceptually here. We're going to get into the meat of trading itself in just a second here, but there's different types of retracements. You've got what's called a thrust in a given direction. In this case, it was up. And then here you can see we had a series of shallow retracements into here where it found support right in here. So for instance, this little pullback would be considered a long trade or a buy. Everybody in here said we're getting long in here. The trend's up, so we're buying, right? Here is another thrust right here like this. We have another pullback here. Long trade. You get the idea. Thrust, pullback, long trade. Now, let's talk about transitions and trend changes, because they're equally as important as knowing what the current trend is. Now, 6:30 Pacific is the open of the equity markets here in California. So 6:30 on this day was right here. Now, remember we said that markets can be in three conditions: up, down, and sideways. Now, the characteristics of a downward move are the opposite of an upward move, where you have the background is predominantly red. The bars are red. The mid-band and all the bands are stair-stepping down, like such. And we are said to be in a downtrend. So in a downtrend, we have thrusts and we have retracements. So let me show you some examples here. So here we had a thrust, broke a support level, came up, hit the mid-band, rolled over. That could have been a short right there. We come down, we have another thrust, like such. And then we have another retracement. So each one of these pullbacks, these retracements in the downtrend, were opportunities to sell the market. Sell the market. And like I said, in a few minutes here, I'll get into the specificity of the location of trade entries. I'm not going to do that right now. I'm going to keep it pretty high level until we get through the basics. Make sure everybody's got a good, solid foundation, and then we'll start building on that for actual trade entries. Okay? So everybody's clear about that. Now you might say, well, Charles, look, there was this sort of transitional thing here, and why weren't you buying that? And let me ask this question. Is it possible at market opens and news events that you can get trend changes? Yes or no? Market opens and news events, can you get trend changes? Yes or no? What do you think? Absolutely. Heck yes. That's right, David. Right. So what explicitly I'm saying here is that while, sure, in the overnight session, the trend was up, no question about it. And you might come in the morning and see this all the time. Market's up, market's way down. They've run the thing, 100 ticks overnight, and, you're thinking it's going to chop around. And then all of a sudden it changes trends. Now, here's the thing to remember. This is really important. It's like if you're going to remember anything, this would be one of the things to remember. When we talk about the state of the market, the condition of the market, the trend, if you will, the trend, when it looks to change, can take several forms, and we need to keep this in mind. So we can go from, the most basic, of course, is up to down. That's pretty clear. I think everybody can understand that. The market was going up, and then now it's going down. Now, does it always just go from up to down or down to up? That's pretty much it, right? We have a trend change in a market. Any given market could be gold, could be anything. We're either going up and then we go down, or we go down and then we go up. That's pretty much it, right? That's the extent of our trend changes. That's it, right? Up to down, down to up. That's all we need to know. We're good to go. What's that, David H? Peter W? I see some typing coming in here. Daniel P, what about sideways? Oh, yeah. Yeah, we forgot about that other thing called sideways. Yeah. Okay, good. All right, so then the other possibilities then for us are we can go from up to sideways. Yes. And we could go down to sideways. Right? So in actuality, there are four conditions when we talk about trend or trend changes. Up to down, down to up, and of course up and down to sideways. Four possible transitional conditions. Now, why do we care about that? Who cares? What difference does it make? All right, yeah, I see. Okay, we transition here, and we were going up, and we were going down. Well, it has everything to do with your decision making, right? In other words, what type of trades are you taking? For instance, over here in this up trade, we're not shorting these thrust moves, are we? Every time it thrusts up, are we shorting up here? Are we selling market? No, 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 no. We're in an uptrend. We're buying pullbacks, right? We're buying pullbacks. All these things are long. We're not buying in a downtrend. We're not buying thrusts into support. We're not buying or selling that. We stay away from the thrust moves. Does everybody understand that? That's another important thing here. I'm going to go ahead and add that text to this because we want to always remember that. Keep this in mind. Whenever you're trading any instrument, we always need to remember we never ever, or extremely rare, let me put it this way. It's probably a better way to put it. Buy or sell thrust moves. Now I got a good question, and you might say, "Okay, Charles, that seems pretty straightforward. I can wrap my head around that. Don't ever buy or sell thrust moves. That's pretty clear." Now, the big question is this: how do I know I'm in a thrust move? How do I know? How do you know? How will you know? Tomorrow morning you wake up, you pull up a chart, looks like this. How do you know when you're in a thrust move? And how do you know when you're in a retracement? Let me advance the chart and we'll talk about it. How about here? Let me ask a couple of yes/no questions to help you see this, okay? Is that a thrust move or a retracement? T or R? Right here, this move right here. Is this a T for thrust or an R for retracement? This little move right here that I put the arrow on with my cursor. Everybody's typing in thrust. Okay, good. How about this right here? Is this a retracement? R for retracement, T for thrust. Is that an R for retracement or a T for thrust? Right here. Everybody's typing in R's. Good. Right. So, it stands to reason, and I think everybody can follow this because it's pretty straightforward, that the thrust part of a move, when you are in a downtrend, is down. Right? I know I might be stating the obvious, but some people still have a very tough time understanding that, right? So if the trend is down, then the thrust part of the move is the push down in the direction of the trend, right? Now, if the trend is down and you are going up, as you were right here, this is considered the retracement. Because it's the opposite of the trend direction. That's how you know, right? That's how we know whether we're in a thrust or a retracement. The thrust in any market will always be in the direction of the trend if you have a trend. That's the important thing to remember here, right? So over here, when we're buying and getting long, the thrust moves are up. So we talked about thrust moves. Thrust moves are up. That's a thrust move. That's in the direction of the trend. In this case here, a retracement move would be here. That's pulling back in the opposite direction of the trend. Now, any questions on that? Any questions on the basics? Because now we're going to move on to other topics like sideways ranges, which are completely different than this. At what point does a T become an R? Okay, we'll look at that, James. When it went to line 7 area, would that be a trade up? Okay, let's advance the chart and let's start to get a little more in depth of what's going on here, okay? That was just the foundational basics. Now I'm going to do a couple of these where we're going to work together, and then I'm going to sort of pretend, if you will, that we're in real time, and you're not going to see the data. Okay? Because that's going to help you. First, you have to visualize it, and then you have to act on it. So some of you are still learning at the very basic levels, and that's okay. So we'll help visualize it, and then we'll talk about acting on it. Okay. All right. I advanced the chart, and now the market looks like this. So this was the other day. This would have been, I think this was, what's today? Today's Thursday. So I think this was yesterday morning. So here we're at about 7 o'clock Pacific. We had the uptrend. Excuse me. Hold on a second, please. Sorry about that. Now, when we look to the right of 645, right here, and I'm saying this area right over here to the right, is the market still going down? Has the market transitioned to up? Or is the market now sideways? I'm saying specifically right in here, where my cursor is, to the right. From here over to here. It's just type in a U, a D, or an S. It's either up, down, or sideways. You only have three choices. It can only be one of those three, and it's going to be one of those three. It's not an I don't know. I can't tell. I have no idea what it is. We can't do that. Okay, if you feel like, when you're trading, sometimes you're like a little bit of a deer in the headlights, and you're kind of staring at a chart, and the bars are shooting all over the place, and you're trying to figure out what to do. The reason for that might be that you are struggling somewhat to figure out the current market condition, and there's nothing wrong with that. That happens to everybody. But the way around it is you have to decide what the current market condition is, and then how you're going to approach it. So yeah, everybody typed in S for sideways. So here we are going sideways in this area right here. Some people call it consolidation, chop. There's different names for it, but from here over, we were in a sideways condition. Consolidation, choppy. What makes this area over here, aside from the background color, different from the area over here and the area over here? What's different about this? Why is this so different than this and this over here? Pre-market and right at the open. What's different about this? Why isn't it the same as something over here? What's it doing? Well, yeah. When a market is in a sideways position, are we considered any longer to be trending? When we say sideways consolidation, does this equal the term? If I could put on here, let's do one more. Should I could type in here trending, right? Sideways consolidation equals trending. That makes total sense, right? No. Sideways consolidation means that there is no trend. That's what that means. There is no trend. There's no trend. It's set sideways. There's no up, down movement. No, that is the essence of no trend. It's the definition of it. There is no trend. So now when you say there's no trend, man, I'm confused, Charles. You're throwing a loop at me here. I was pretty clear over here. The thing was green, it was going up. You're telling me to buy. I can understand that. Over here it's red, you're selling. And now you threw this sideways thing at me. What the heck am I going to do with this? Well, what we do is this. We put a line. Gary does this all the time live in the room. And we'll get into more detail about how to do this in a minute. Let's just follow conceptually with me here, okay? We put a line at the top of the range, and we simply put a line down somewhere near the bottom of the range. And then we quickly make an assessment. We see how large this area is. So we had support down here around, let's use a round number of 1510. And we had a resistance up around 1250, 1300-ish up here. That's almost 30 ticks, 25 to 30 tick range. So is this range tradable, yes or no? Just type in a Y or an N. You know, just literally that's how quick these answers can be. Just go, boop, just hit a letter. Don't think about it. That's what we want to do. We want to train our trading minds, our muscle memory of trading to instantly see what's happening and translate that into what we're going to do. So that's why it's so important to do these exercises, is we have to look at several markets. We have to determine, is it trending? What's the trend? Are we buying? Are we selling? Or are we in a range? Okay, good. Yes, this is tradable. So the rule of thumb, and it's pretty simple, is anywhere about around 20 to 25 ticks minimum is tradable. This is close to 30 ticks, so it's absolutely tradable. Now, final question in regards to this range. So we are not in a trend. We are in a range. That means lack of trend. Yes? Now, for those of you who said, yes, okay, that's a tradable range, well then now here's the next question for you. And even if you didn't say it was tradable, it's a question for everybody. Is the primary mode of entry on this range going to be to sell or short the top of it and buy it back at the bottom? Or is your primary mode of entry in this range going to be buy support, so you're getting long down here, and then sell it up here? So the first one would be S for shorting. So we're clear about this. I'll give you 10 seconds on the clock to help you out. So you're shorting. Use your primary mode of entry to short the top of the range and buy it back at the bottom. Is your primary mode of entry to buy support here? So you're getting long down here at the bottom. You're not short. If you take this vote, you're not shorting it. You're only getting long here. Yes? And then you're selling up here. You're taking your profits. So that would be a B, S, B. And then would you do both? Both would be, go ahead and type in the word both. So in other words, you would be saying, well, you know, I think I could short up here, Charles, at the top of this range. The resistance is pretty clear up here. I could buy it back down here, and then I can flip it long. So I'd be trading both sides of the range. How many both voters are in here on this range? But you're doing both. And how many of you are buying and how many of you are selling? So cast your vote on what your primary mode of entry in the range would be. Wow, quite a mix. Wow, we got a big slew of boths coming in. David H., Daniel, Bill, D., Albert, all voting both. Peter W. is shorting the top. James, Roger, Mario, and Dennis are short. Gary's buying. Gary T. Hey, Manny, I didn't see you come in. Hey, Byron. All right, so we got a good faction of both. Now, so we made our determination that the range is tradable because it's over 20 to 25 ticks. It's almost 30 ticks. So the answer was yes, it's tradable. Now, there's a couple of ways to look at how you're going to trade it. If you are coming out of a downtrend, technically when you're sideways and you're hitting the outermost band, these are considered deep probes or what we call phantom trades. In other words, you could make the case that, yes, we've changed from down to sideways. We all agree on that, yes? And so your primary mode of entry should probably be to short the top and cover down here. So you're shorting down here and you're buying it back. Now, here's the thing. When you trade ranges, okay, it's different than a trend in the fact that you don't necessarily have this notion of thrust and pullback. That's no longer present because thrust and pullback applies to a trend. So we can't necessarily say in here what is the thrust and what is the retracement. There is no thrust and retracement because we set up here, there is no trend. So when you do that, let me just clarify this so it's all clear to everybody. In the consolidation range, if it is tradable, you are simply trading the range. And what do we mean by that? Trading the range. That means you're trading support and resistance. There's no longer this notion of thrust and retracement that was present in the range, right? We don't. I mean, in the trend, we're no longer in a trend, so that doesn't apply anymore. We're selling or we're buying. Now, The thing about this is a pretty clean, well-defined range. And that what I mean by that is that the top is pretty close to each other and well-defined. The bottom is fairly clean and well-defined. And so it might be possible to sell up here, buy it back, sell up here, buy it back. Get long, and then at some point it's going to break. Now, a word about entering ranges, and you can use your tools for this. This is what Gary teaches with all his details of how to use the object trader. So I'm not going to spend a lot of time on that. He spent hours on teaching everybody how to do that. So that's not the purpose of what we're doing here today. I can show the tools a little bit later. We can talk about the tools a little bit. I'm talking about conceptually looking at a market and deciding on how you're going to approach it. Right? How are you going to approach it? Now, for those of you who are shorting the top of the range, you have to fade the top of where you get in. What that means is this. Let's say that you see a swing here at 1280-ish, and you want to sell here. Well, you can't put your sell order right here, or think that it's going to hit this 1300 or something like that, or 1350. You can't do that. Okay, you can't put it up here, because in this case here, you would have never even filled short. Right? So when we say fade the top, fade the bottom, what do we mean by that? What does that term fading mean? Fade that swing. I'm going to fade my trailing stop behind 1513 by 4 ticks. The term fading, what does that mean? Fading. Well, in the case up here, when you're selling this short, in order to get filled short, you have to put your sell order 4, 5, 6 ticks inside of where the market goes to sell. In this case here, you'd probably be looking somewhere around 1230-ish. So that when the market came up and hit it, it would fill you short. Yes? Likewise at the bottom, we don't put our buy orders or buy to cover orders right at the swing. We don't do that. Okay? We have to come inside of where the swing is located, right here. You're going to come 4, 5, 6 ticks up, and you're going to get long or buy to cover. So the meat of your trade in a range is going to be between where the top and bottom are faded. In this case here, the short is here. For those of you who voted both sides, your long trade is basically here. This is the meat of the range trade. It's not at the top, exact top. It's not exactly at the bottom. You're fading the top and bottom. And so this is the essence of the range trade. Now, now that we know that, do you think it's a good idea to start trading the midband? Like, is this a good trade right here? Putting a box. Is that a good box? What do you think? Is that a good box trade? When you hear in the room, I'm going to box that in. I'm boxing that in. Okay, I'm going to go ahead and box that in. Right here at the midband. Is that a good trade? What do you think? This big old box right here. That's a good box. Do you get one like that tomorrow? Let's all take it together. What do you think? Okay, good. D, good. Good. Okay, good. And there's a lot of questions in the live room about this, so I'm going to pause for just a second and address this. There's a lot of question about what is a good box and what is not a good. When does a consolidation patch become not a good box? It's two things. First of all, it's the size. So in this case here, we're looking at probably somewhere around, 1010 up here to 1160 almost. So that's 15 ticks plus or minus. That box is too big. Generally, you're going to want to see a consolidation box that's down in the 4, 5, 6, 8 tick range, under 10 ticks. That's kind of a good roll. Although it really depends on the box. Like for instance here, this would be a good box right here. Anywhere you see tight consolidation is a good box. Part of the reason we don't trade the midband in ranges is because if you said, well, I'm going to get in here, there's no meat on the bone. When you say meat on the bone, okay, you're filled on this candle long, let's say, but then where are you looking to get out? You said, well, I put a midband box right there, Charles, and I got filled long on this bar right here. Okay, so that's cool. Now you got to take some profits. Where are you getting out? Where are you getting out? Up here? Up here? Right there, maybe? How much money is in this trade? Right here. That's where you're getting in, and that's where you're getting out from this mid-band box. No, there's no meat on the bone there, Jay. PW, right, everybody. There's no meat on the bone. You've got to position your tools and your entries so that you at least get 5, 6, 10 ticks off on a scalp. If you can't at least get a scalp, then you shouldn't. That's not trades you should be taking. So you want to look at where you're going to be getting in and getting out. Generally speaking, in range-bound trading, you're not taking mid-band boxes, generally speaking, mainly because we're trading support and resistance levels. And those are located somewhere outside of the mid-band. Okay, let me just put that in there as one last comment so we can remember that one. So generally speaking, in a range, in the range, you're not taking I'm going to just say no mid-band trades. I mean, there are exceptions to everything. Okay, there might be a very big range that has, like, I don't know, 50 ticks. Mid-band's really nice and juicy right in the middle, and you can pop up and get 10 above and 15 below. That would be an exception to that, right? But generally speaking, you're not going to be taking mid-band trades in a range, in a tight range. Certainly 20 or ticks or less, you're not doing that. Okay, good. Any other questions on what we've covered so far? That is the basics. Okay, now what we're going to do is no, the white dot is not a Fibonacci number. This is not a Fibonacci number. So I see we got some questions from people who are trying to understand what they're looking at here. Okay, so just real quick, backing up, if you just put a bar chart up here and had nothing on it, it would just be a series of bars. You would just have some bars here. Okay, they may have color, they may not have color. So what we're doing with the Viper indicators is that we are adding form and structure and color to a market so we know how to trade it. Like if I took all these indicators off of here, you would just see bars going up and down, and you probably wouldn't. It'd be very hard to see trades. Now, these little ellipses right here, these are the predictors. All right, you can toggle them on and you can toggle them off. Predictors. Predictors are generally where support and resistance levels are going to be, and they paint in real time. So as this market's going up, for instance, these resistors, these predictor bubbles are painting. They're painting. They help you visualize where to get in and out and where you might find support and resistance levels on selling or buying the market. Now, if you find them too confusing, it's no problem. You just turn them off. And when you want to look at them, you toggle them back on. So these are predictors. Okay? Now, these levels that are called out here are swing levels. Okay? So like in the room, for instance, you might hear a comment like, oh, Russell peaked out around that 1450. We might get a pullback, and I'm looking support around anywhere around that 13 area for a buy to get in. So I'm talking about this. Or if you're already long, put your stops on a close down here. So that's what that means. That would be those swings identified by our software. Viper software identifies these swings. Okay. And then, of course, you have the bands and the bar color. So what we're doing here with these indicators is that we're trying to give the market some form, some structure to help us evaluate what to do. David H., the quick question about the box you drew at 6:30. Would you have any bias in that box, and why? Right here? And I think he's talking about this box right here. Now, we have to go back to answer that question. We have to go back and pretend we're in this condition. And I'm going to answer it like this. At the time this box started painting, what was the trend? And I'm saying explicitly this box right here. At the time that this box painted, what was the trend? Right here, this box. This is his question. So would you have a long bias, a short bias, or no bias? Long bias, short bias, or no bias to this box painting right at the open of the market. At the time it painted, okay, we're trying to recreate when this box actually happened and what it looked like when you drew it. All right, now that's kind of a trick question. Why is it a trick question? Well, Here's why it's a trick question. If you had this box drawn anywhere back over here where I've drawn 1, 2, 3 boxes, this is actually a circle, but it's a trade entry. This would be a long bias only because the trend is up and you're looking for a break upward. However, the exception to that we talked about, I don't know, 20 minutes ago when we opened up here, maybe longer, was that you're at the open, you're right at the open, and markets can change directions. Now, a word of caution and potential risks and returns in this area. If you say, well, so what are you saying, Charles? You're kind of wishy-washy on this. Is it long only or both? What is it? Obviously, it's not short only. The trend's up. You can go long only here because at the time this happens, you're expecting trend continuation, yes? You're not necessarily thinking reversals, although you're aware of the fact that the market open is right here. So you might get a reversal. And you could have very well turned on short, in which case you actually got short on the close of this bar right here. One of these bars right here would have actually gotten you short. Now, that is the more aggressive way to trade an open. And I must issue a word of caution. That's not a good idea for all instruments, especially NASDAQ, because if you traded NASI like that, you might have got creamed because it whipped around and stopped you out 3 times. The Russell and the YM in terms of equities are much smoother. They don't have the deep retracements. They don't have the big thrusts. So for instance, on a NASDAQ thrust, it might go 40, 50, 60 ticks. That same move on RTY might only be 20 ticks. So you're not getting the big moves, okay? You're just not. NASDAQ is notorious for these large, very huge moves, right? You're not going to get that. YM, might go 15 or 20 ticks. Russell, now that's not always the case, but generally speaking, it's much less volatile. But likewise, you're not dealing with those huge whippy. In fact, let's do this. Let's just talk about it. Let's bring it right up. Let's bring it right up and look at it. And I'll show you what I'm talking about. Let me find 630 on the first. And we'll put them right next to each other. While that's loading, I want to come back over here. Now, I don't recall exactly what I did. I would probably take an upward bias until this was broken. And then once it was broken, I can start looking for shorts. You don't have to worry about, now occasionally this will happen. Uh-oh. What's going on here? NASI chart's getting a little freaky on me. Come on, NASI, be a little friend. NASI, don't lock up on me. What I'm saying is this, is that if it's going to thrust, if it's going to trend change and go in the opposite direction, I had 7, 8 plus 9, 10 times, it's going to pull back at some point and give you a chance to get in. So if you go upward bias only on that box and you miss that first little short, it's okay because it pulled back at the midband and rolled over. So you got another chance to take a short anyway. All right, here we go. I think I got it. Okay, let's see here. Let me get first up. I'm going to try to put these right next to each other so you can get a sense of the difference in volatility between the Russell at the open and NASDAQ at the open. Okay, here's the Russell. Just give me a second. I'm shuffling these charts around. Getting back to the first at the open. Stand by, please. Just 1 second, please. There are so many bars on NASDAQ. Oh, my goodness. Gee, many Christmas. That's a second. I got to go back another day. Gee, there's like 1,000 bars here. NASDAQ just has so many bars. Hold on, please. Hey, just a quick show of hands. How many of you trade the Russell? How many of you trade NASDAQ? Or how many of you trade both? Oh, good, pretty good mix. We got some Russells, we got some NASIs, and we got quite a few boths. Okay, good. All right, good. Quite a few you're saying RTY, but no NASDAQ. Okay, good. It's understood. All right, here's NASI at the open on the exact same day at 6:30. Okay, hold on. I'm setting up this chart. Let me do it this way. Hey, you know what? I'm gonna do it this way. I'm gonna do it this way. Let me unpause the screen. There are so many things on here. Is it okay if I go ahead and clean this Russell chart off? Is that cool? Everybody understand what we talked about? I'm just gonna clean this thing off because otherwise it's gonna be too confusing. All right, let's just clean that puppy up. There we go. All right. You can show predictors or not show predictors either way. You know, it's up to you. This is the opening on, this is 6:30 Pacific on NASDAQ right here at this line, and 6:30 Pacific on Russell was right here. So 6:38, 6:39 on the Russell, within 8 to 9 minutes of the open, the Russell had done this. It had come down, kissed the midband, come down, comes up just shy of the midband, and then gives you another nice short. Let's look at NASDAQ in that same exact time frame. From this line over, it did this shot down, spiked back up in your face, came above the midband, came down here, spiked down. How would you trade this on NASDAQ right here within the first 8-9 minutes? How would you trade this on NASDAQ in the first 8-9 minutes? And can you see the difference in volatility between this on the right and this on the left? So this is what I'm trying to tell you. Here's a very marked difference in two different equities. The Russell is the mid-cap futures, right? NASDAQ is the tech futures, okay? Now, technically speaking over here, you know, you could be shorting here, but this is what I was trying to tell you. NASDAQ many times, it takes on these characteristics. You'll get these spikes. You think it's going to break down. It breaks a swing. And then next thing you know, you blink, and a minute later, the thing's back up in your face, stopping you out. You're trying to figure out where you want to short it. Spikes down in your favor. You short a rollover, comes down, gives you a few ticks, and then bam, it's right back where you got in. This happens a lot on NASDAQ. If I was to advance these charts next to each other, you would see that all day long. Now, if you said, well, okay, Charles, I hear you. I hear what you're saying. That's cool. But I still want to make more money. I like NASDAQ. Well, then what you're going to have to do is adapt your trading style to the spikiness of NASDAQ. And there are many times, and that's right, Albert, where you're going to just simply go for 10 ticks. You're not going to catch the runners sometimes. Okay, I'm about to run out of time here. I'm running a little bit short. How many of you trade gold and oil? Does anybody want to look at crude oil and a gold chart? Any gold and crude traders in here tonight? Got a gold chart right here, teed up, ready to go. Anybody? Type in either a CL or a GC if you trade gold or oil, and I'll pull up a chart for us to look at. A couple CLs. Okay, good. CLs. All right, let me start with a crude. Let me get a crude chart over here real quick. Because the personality of crude is very different than the equity some days. Some days it tracks it, some days it doesn't. Let's get a crude chart up real quick. Stand by. Oops. All right, in this case here, I'm going to do a series of exercises. I think we've gone enough through the basics. Kathy, RTY is the Russell, and it is free through your Ninja Trader Continuum or CG. Was it CGQ? CRG. But you have to have the latest version of Ninja. You have to have version 35. So you got to download that on the website from Ninja. Make sure you have version 35. Everybody know how to check the version? Anybody not know how to check what version of Ninja you have? Anybody not know how to do that? Everybody knows how to do that? You have version 35? Okay, well, you got to go into your instrument manager and then add RTY into your instrument mix, and then you can pull a chart up. And it should be free. because it's part of the CME group. It used to be through ICE. Okay, it used to be through a separate data provider, and they charge $117 a month. But that's no longer the case. In fact, it's going to come off of ICE, I think, in June of next year. All right, now let's take a look at crude. And this is today. And I'm going to help orient everyone to where we are at. 1 second, please. We're going to do a little exercise together on crude. Ready? Here we go. Here's crude today. I'm just going to toggle those off for 1 second, please. Okay, here we go. Okay, midnight Pacific was right here, so this is the European session, pre-market. Pit open is at 6 a.m., 5:55. Gary's opening up the room. So when you opened up the room this morning and looked at some charts that looked like this, this is what it looked like. So are you up, down, or sideways on crude at the pit open today? U, D, or S? Up, down, or sideways on crude oil this morning at 6 a.m. Pacific? Cast your vote. Up, down, or sideways. It's one of those three. Okay, I can help you out there. It's going to be one of those three. Sideways. Good. Lack of trend. There is no trend. Now, and this is the other sort of important thing that I want everybody to take away tonight, if you can. What's the first thing we need to do when we pull up our charts in the morning and we're getting ready to trade? The first thing. What's the first thing we need to do? Sure, we look at the chart. We try to determine if it's up, down, or sideways. That's all part of it. But what else do we do? What should we get in a routine of doing? I do it every morning when I get up and I look at the charts. I do this every single morning. Go get coffee. Okay, good. Get your breakfast. Let the dog outside. He's got to go. Okay, after you did all that, you have an English muffin. All right, you got your coffee and your snack. You draw your lines. Good. Good, good, good. You draw support and resistance lines right on your chart. So in this case here, it's pretty easy. We can see that there was some resistance on crude, more or less up in here. And we can see that there's some support on crude down in this area right here. There's a couple areas. There's one down here. And there's one kind of right in here. Now, we still get a lot of questions about that. Well, how do I know where to put the lines? You know, the lines aren't really clear to me. I don't see why are you putting lines in those spots. I can't follow why you're doing that. I don't see it. So it's a visual thing. So what you do is you look back, you take the right-hand side of the chart that you're starting at. Here's the present time, 6 a.m., and you look backwards. And this isn't a perfect science, okay? You can generally see, I'm just going to do a couple here. You had kind of a swing there. You had kind of a swing right here. You had a little bit of a swing, poke its head up right here. This one went a little higher. Hold on, stand by. This one actually changed the background green. And here you have some swings down here. So as I said, there's not an exact science to this, okay? You have to look where sort of a preponderance of candles are swinging at, okay? Wherever they swing up to, okay, that's considered resistance. Wherever they come down to, that's considered support. We think of it, a healthy way to envision this, and I've said it 1,000 times over the years, is it's an area of support and resistance. So we can say that plus or minus 10 ticks or so, there is resistance on oil around 54.35, plus or minus 6 or 8 ticks. So that's the range. So it's an area where oil comes up and it hits its head and it rolls over and goes down to check support. Likewise down here, we can see that there is many candles that come and visit this area, and so this is the range. How many of you want to trade this range? Is this range tradable on crude at the pit open? What say you, team? Yes or no? Tradable? What do you think? Would you trade it? If it looked like this tomorrow morning, would you trade it? Cast your vote. Would you want to take it? Or would you stay away? By the way, that's two different things, just to be clear with everybody, okay? I want to be clear about this. That's two different things. I'll talk about it in a second. I see a bunch of votes coming in. A whole mess of no's and just a couple of... Okay, Albert, no problem. I see some of you got to take off. Yeah, a few more minutes, we'll be wrapping up. Okay, so there's two different things. Okay, so let's be clear about this. Okay, so because there's some confusion about this. There is the question of tradability. Yes or no? In other words, is it physically large enough to trade? Yes or no? Okay, that's the first question. Once you assess it with your support and resistance, then you can say, okay, yeah, it is. No, it isn't. It's not big enough. I got to stay away. But then the bigger question is, if the answer is yes, should you here, right? Should I trade it? Now, what is this second question a function of? Okay, so you assess the range. Is it tradable, yes or no? You answer that question. This is, I don't know, 20 ticks. Let's say yes. Okay, so the answer is yes. And then the second part of the question is, should I trade it? Now, what is that dependent on? That second question, should I trade it? What is that? How are you going to answer that one? How are you going to answer that second question to determine whether tradability was yes? All right, cool. Now, should I trade it? Good. Oh, yeah, okay. Hey, I got some great answers here. Let me give some feedback what we got. That's perfect. Perfect. Okay, good. All right, so David H. says this. It's a function of how you prefer to trade and what your personal trading style is. Good. Perfect. Yes. Mario says, that range is not within my current comfort level of trading. Good. That's how you answer that question. Perfect. Manny says, my psychology and trading plan aren't conducive to that. It's based on your own ability. Exactly. So the answer to the second question is really a function of you and your personal trading style and whether you're comfortable with it or not. So how do we figure that out? Well, what you're going to have to do, and this isn't a universal thing. It's a function a lot of time of, how big the range is, how clean the top and bottom are. Is it all kind of hitting the same levels, or is it all jammed up like this, up and down? It's not clear. Should I really be buying here? Should I fade down here to get in? Should I be shorting the top, buying the bottom? It's not getting where I want. I'm not comfortable with that. If the answer is I'm not comfortable trading the range, well then, even though it's tradable, then you choose to stay out. Now, the way you determine that is you take the different instruments that you're trying to learn. So let's say in this case, crude. Could be anything in here. Let's say you're learning how to trade gold, and a gold has a range. Well, you would go into sim, and you would start trading that range in gold until you saw whether you can nail it and get a high 70, 80% win rate. If you go into, let's say, hypothetically, just pick anything here, YM, and you say a range, and you do it in sim, and you just can't, every time you get in, you get stopped out. Or NASDAQ, you go in there, you see a range, you put your lines, like, okay, I got it. I put the lines, I'm going to buy, I'm going to sell. I see what to do. I'm not trading the mid-band. And then you just get hammered. You get wham, 1, 2, bam, 3, 4 stop outs. Well, then the answer is no, don't trade it. So it's a function of the range itself and your comfort scale with that particular instrument. Now I'm going to advance oil. This will be the last exercise right here we're going to do together, okay? And then we're going to wrap up. And when you see a trade, I'm going to pretend it's real time. We're going to look at it together as a team. And this will be the last exercise for the evening. You type in the letter T. When you see what you think is a trade, you type in the letter T. Is everybody ready? All right, so there's no time on this. I'm just going to go bar by bar and advance the chart. We'll go through the whole morning here, okay? Here we go. Starting right now. Okay, I'm going to start advancing the chart. We're in here, and we're in the live room with Gary. He's got the pit. He's got the crude pits opening right here. You got your own chart up right in front of you. You're looking at it like this. When you see a trade, you type in a T. Let me blow these up a little bit here. Blow up the chart a little bit. Let me get this set up here. There we go. That's better. Okay, I'm going to keep advancing. You're at 6:54. You're just turning into 7 o'clock. So you've been watching this chart for almost an hour, depending on when you came in. You watched it at 6:30, about a half an hour. Okay, I'm going to keep going. Okay, now you're at 7:30. You're coming up on 7:30. Type in a T when you see a trade. Coming up on 8 o'clock, 8:10, 8:11. Okay, now we're at 9, coming up on 9 o'clock a.m. Pacific. Been watching this for 3 hours now. Okay, now you're at 10:30. All right, so I'm going to pause it right here. All right, so I saw several T's coming in, and some of you were calling how you were taking it and where you were getting in. So let me ask. This will be one of the final questions as we assess this situation together. When looking at from 6 o'clock a.m. Pacific forward here, we all see the range, and in all fairness to everybody, I should have adjusted this line. I was going to pause and do that. My apologies, because the range changed. Right, we can see the range came up like that, so that was actually the range here. Now, inside of this range, so crude was in a range from basically the pit open, even in the pre-market, all the way through to 10:30. It's in a range. And this is your primary mode of entry. When you typed in the letter T, and many of you typed in T's here, were you shorting here? S for shorting. So when it came up, you're shorting this. Or were you buying down here? I'm not going to give you a both option because I don't think there's a both here. Okay, in my view, there's not a both. There's a one or the other. You got to pick. Either you're selling it. So when you watch this chart advanced in real time together, we moved the chart like we're looking at the bars in real time together, right? Are you selling? Are you shorting resistance and buying it back at support as your primary mode of entry? Or whenever it pulled back in down into here, you're buying it and getting long. You're getting long down in here. So when it pulls back, you're getting long. Buy. Okay, good. In my view, we are sideways to up. And why do I say that? Well, you could make the case that if you go all the way back here, that you were starting to get a series of somewhat lower highs, and the market was pushing this top here. So in my view, if you traded this range on oil in the morning, you were buying pullbacks and taking profits at the top of the range, and not necessarily shorting it up here. I would not be shorting this, especially over here when you got a green background. When you definitely got over to here, hopefully nobody is saying that you're shorting this, okay? Because, in fact, several of you said long trade when it hit the midband right there as it started to set up this higher range. And that was correct. These were long buy trades. These were long buy trades here. Each one of them. Every time it hit there and bounced, that was a long trade. Long trade. Long trade. Okay, everybody sees it, right? And then, of course, you can see that off into the morning it took off, and then oil never looked back. I would be trading the buy side of this range, looking back on it today. I wouldn't be shorting it. Mario says, I really like these exercises you do. Not only they help me spot entries, but it also shows me a better way to stand down if I'm in doubt and when to jump in. To wait and know that another bus might be leaving the station. Well, that's why we do these exercises, everybody, okay? Because you have to get comfortable with, and sometimes it's on the fly, and these bars are coming at you sometimes fast, sometimes slow. And you have to be really clear about what you're going to do. If you want to succeed at trading, you got to be really clear. You can't be wishy-washy. You can't see this range and say, well, I don't know what I'm going to do with that. Should I trade it? And many, many times, the answer to your question might be to simply stand down. How many times are we in the live room and there'll be a quiet period where, Gary doesn't say too much, maybe I'm not saying too much, and it's kind of quiet in the room? Well, why might that be? Well, we might be standing down. We might just be watching the market and trying to figure out what it's doing to decide what we do next. And there's absolutely nothing wrong with that. You're going to increase, if you're able to manage that, your trigger finger, if you will, to understand that there's times when you just aren't going to be in sync with the market. Maybe you're still a little bit confused about what trade you want to take, or you get in and you get popped early. Whatever the condition is, it's perfectly okay to stand down and not take trades if you're not comfortable. And it's equally as important to know this as to know where to get in. All right, let me stop the recorder. Thank you for